Imagine working hard to save money, cutting back on daily expenses, resisting the urge to buy that new gadget, only to find that financial institutions reward people who carry debt instead of those who practice discipline. It feels backward, almost like the system is designed to keep you in a cycle of borrowing rather than building wealth. Why does it seem like the more you owe, the more benefits you get, while self-control and saving go largely unnoticed? By the way, this channel posts one insight like this every day, so if this breakdown helps you, consider subscribing. Welcome to Brand Name, where we uncover the surprising truths behind money and power. Today, we're unraveling the paradox of how the financial system often favors debt over discipline, and what that means for everyday Americans trying to get ahead. Take the example of credit scores. At first glance, they're meant to measure your creditworthiness, how likely you are to repay borrowed money. But look closer, and you'll see a curious bias toward debt. Using credit cards regularly, even carrying a balance, can improve your score. On the other hand, if you pay off everything in full each month and avoid borrowing, your score may not grow as quickly. That's because credit scoring models reward consistent use of credit and responsible repayment, not the absence of debt altogether. Now, why is this the case? The financial industry thrives on borrowing. Banks make money from interest payments, lenders benefit when you take on more debt, and credit bureaus generate revenue from companies eager to assess your credit risk. It's a system crafted to encourage borrowing because, paradoxically, carrying debt is seen as a sign you're actively engaging in the economy. Consider how mortgages work. Buying a home typically involves taking on a substantial loan, sometimes hundreds of thousands of dollars. Mortgage interest is even tax-deductible in many cases, making it financially advantageous to carry this debt. Meanwhile, if you try to save and buy a home outright with cash, you lose out on those tax benefits and the opportunity to build credit history that lenders look favorably upon. This isn't just an abstract problem. It has real consequences. People who live frugally, avoid credit cards, and pay off debts quickly may find themselves at a disadvantage when they want to make major purchases like a car or home. Without a strong credit history built on managed debt, they could face higher interest rates or outright loan denials. The irony is that the very behavior that fosters financial health, living within your means and avoiding unnecessary borrowing, can limit your access to credit and financial mobility. On the flip side, those who carry and manage debt responsibly can access better financial products, lower interest rates, and rewards programs. Credit cards, for example, offer perks like cashback, travel rewards, and purchase protections, but only if you're using credit regularly. If you avoid credit altogether, you miss out on these benefits entirely, even if you're financially disciplined. This dynamic creates a dilemma. Should you go into debt to improve your financial standing, even if it means paying interest? Or should you stay debt-free and potentially face barriers to financial opportunities? Unfortunately, the system nudges many toward the former, rewarding calculated borrowing over pure saving. In a broader sense, this debt preference reflects cultural and economic values embedded in the system. Consumer spending fuels economic growth, and borrowing amplifies spending power. So, while it may seem unfair on an individual level, the system encourages debt as a driver of the economy. For the average person, this means navigating a landscape where financial discipline doesn't always translate into immediate rewards, and where borrowing can be as much a strategic necessity as a risk. As we continue, let's dive deeper into how these incentives shape behavior and what strategies you can use to work with, not against, this system. One striking example is the way credit card companies design their reward programs. They don't just want you to spend, they want you to carry a balance. That's why many cards offer lucrative sign-up bonuses or cashback rewards tied to minimum spending requirements, encouraging more purchases. But here's the catch. If you pay off your balance in full every month, you avoid interest charges, yet rarely does this behavior get a direct reward beyond a better credit score. Contrast that with the rewards of debt itself. Let's say someone keeps a $5,000 balance on a credit card with an interest rate of around 18%, but earns 2% cash back on their spending. Even though they're earning rewards, the net effect is negative. Interest payments often outweigh any perks. Yet, because they're actively revolving credit, their credit utilization and payment history keep their credit score healthy, granting them access to other borrowing opportunities that might be off-limits to savers. Then there's student loan debt. a particularly nuanced form of borrowing. For many, taking on student loans is the only practical route to higher education and better paying jobs. But the debt itself can be a double-edged sword. While it may limit financial freedom for years, it also establishes a credit history. Recent graduates who've never had to borrow may find themselves invisible to lenders, their financial restraint working against them. Even more deeply, wealth-building strategies like leveraging debt to invest in appreciating assets reflect this system's preference. Real estate investors often use mortgage debt to purchase properties, multiplying their potential returns. Business owners take out loans to expand operations, betting that borrowed funds will generate more income than the cost of the debt. Here, borrowing isn't just accepted, it's celebrated as savvy financial maneuvering. Yet, outside of these contexts, the message remains clear. Simply saving and avoiding debt won't necessarily open doors. It's a paradox that challenges the traditional notion of financial discipline as the surest path to stability and prosperity. But what about the human side of this equation? How does this debt-preferred system affect our sense of security and peace of mind? There's something to be said for the quiet confidence that comes with living debt-free, knowing that you owe no one and aren't beholden to monthly payments. This kind of freedom doesn't show up on a credit report or in a reward statement, but it carries a deep psychological value. In the end, the system's incentives and the personal values of discipline don't have to be mutually exclusive. It's possible to navigate the system thoughtfully, using borrowing strategically without falling into unhealthy debt. It's about balance, acknowledging the realities of the financial ecosystem while honoring your own priorities and peace of mind. So as you reflect on your own relationship with money, consider this. Perhaps the most powerful form of discipline isn't simply avoiding debt or chasing rewards, but understanding the system well enough to use its tools wisely on your own terms. And here's where the story becomes more nuanced. Because the system rewards debt doesn't necessarily mean it glorifies reckless borrowing. In fact, it's the measured, consistent use of credit, showing lenders that you can responsibly handle debt, that opens doors. This is why someone who carries a manageable balance and makes payments on time can find themselves with better loan offers, lower interest rates, and greater financial flexibility. Take, for example, the practice of debt consolidation. Someone juggling multiple high-interest debts might consolidate into a single loan with a lower rate. This maneuver isn't about accumulating more debt. It's about optimizing existing obligations to reduce costs and improve credit standing. The system encourages and rewards this kind of financial savvy through improved credit scores and better borrowing terms. There's also the overlooked reality that for many people, access to credit isn't just about rewards or perks. It's about survival. Emergency expenses, medical bills, or sudden job loss can require borrowing, even when you'd prefer not to. In these moments, having a strong credit history supported by manageable debt is critical. Without it, the costs can be crippling, forcing people into even more precarious financial situations. But here's an interesting tension. While the system nudges toward borrowing, excessive debt remains a risk factor. Lenders use credit scores not just to reward presence of debt, but to flag risky behavior like missed payments or dangerously high balances. So discipline still matters. It just manifests differently. It's not about having zero debt. It's about managing debt intelligently, maintaining payment consistency, and keeping borrowing within sustainable limits. Now, think about the cultural narrative around being responsible. For decades, parents, teachers, and financial advisors have preached saving, budgeting, and avoiding debt. These lessons aren't wrong. They foster habits that build resilience and reduce financial stress. But when we place these values against the backdrop of a system that favors borrowing, we get a disconnect. This disconnect can lead to frustration or a feeling that personal discipline is undervalued. What if we reframe discipline not as simply avoiding debt, but as mastering the art of credit use? Imagine a financial literacy model teaching not just how to save, but how to borrow smartly, when to leverage credit, how to maintain a strong payment history, and when to pull back. This approach doesn't reject the values of thrift and caution. It complements them with practical strategies for navigating a world where credit rules. At its core, this paradox reflects a larger truth about money itself. It's a tool, not a virtue. Debt isn't inherently good or bad. It's the context and choices around it that matter. Viewed this way, discipline becomes less about moral judgments on borrowing and more about aligning financial actions with personal goals and well-being. So, maybe the real takeaway here is about balance and awareness. Understanding why the system rewards debt gives you a sharper lens to evaluate your own financial decisions. It allows you to harness the system's incentives without losing sight of your values, to use debt as a lever, not a leash. As we wrap up this reflection, it's worth remembering that behind every financial statement and credit score is a person seeking security, dignity, and freedom. Systems will always have rules and biases, but our relationship with money is deeply personal and ever-evolving. In the quiet moments between the numbers, there lies the truest measure of success, peace of mind. And sometimes, that's where real discipline